Hi, I'm Killian Nolan, Head of Product for Cantor Fitzgerald Ireland. Thank you for joining the third quarterly markets update for Merrion Investment Managers. Today, I'm joined by Phil Byrne, Head of Equities. Hi, Phil.
Hey, Killian.
How are you keeping?
Good, thanks. How are you?
Very good, thanks. 2020 was an outstanding year for Merrion Investment Managers on a total return and relative basis. How's 2021 shaping up?
Yeah, we're delighted that 2021 is very much building on the strong performance that we had last year. 3/4 of the way through this year already, our flagship multi-asset 70 fund, or the managed fund, is up over 13.5% as at the end of September. This would be ahead of benchmarks, ahead of the average peer group, and ahead of the long-term track record over the last 10 years, which would average about 10% a year. Subsequently, the lower risk fund versions that we offer, the MMA 50 and the MMA 30, are also doing well, with the MMA 50 up over 10% and the MMA 30 up over 6.5%.
Okay, and what have been the key contributors to the growth this year so far?
Yeah, there's been three real drivers of performance year to date. The first one has been the asset allocation decision we made at the start of the year. So despite 2020 being an exceptional year for equity markets, we felt that all the conditions were there for that to continue. So we maintained a very high exposure to growth assets really throughout the course of the year. The second driver of performance has been our stock selection within that, and our ability to rotate throughout the year into various stocks, whether it be growth stocks, value stocks, to try and ensure we maintain exposure to the leadership. As I said, we felt this year would be a strong year for equity returns, and the key was trying to make sure that you had the leaders. And then our final contributor to performance is our exposure to alternative assets, and in this case it's our own hedge fund, which has produced very strong returns again year to date. This is a unique asset from MIM, as it's something that we manage internally. So the three of them combined are really what's generated the returns year to date.
So obviously, it's a very actively managed fund, and do you think that's going to be important going forward in the current market conditions?
Yeah, very much so. We think active management is in a real sweet spot. So over the last few years, everyone's aware of the zero yield environments that we operate in. Therefore, an old-fashioned passive buy and hold strategy for most asset classes don't work. There's simply no yield available from bonds, from corporate bonds, very low yield available from property investors. So therefore, we feel you need an active approach to be able to navigate all the opportunities and to avoid all the threats that are popping up. And we've seen this over the last 3 or 4 years, whether it's Brexit, the election of Donald Trump, COVID, trade wars, or whether it's trying to gain exposure to all the exciting themes and societal changes that are happening out there that really influence the markets. Things along the lines of decarbonisation, digitalisation, just to name two. And we feel the best way to manage that is through active management.
Great. And Phil, what's your outlook and positioning going into the final quarter? And is there any obstacles that we should be aware of at this point?
Yeah, so we continue to really maintain a positive outlook and positive positioning as we approach the year end. For corporates, it really is a phenomenal backdrop for them. We've got a very strong recovery coming out of COVID. We continue to have a very low interest environment. We continue to have support from governments, and equity markets in particular, just relative to any other asset class, continue to offer you growth, and they offer you a yield as well. And they also offer they offer exposure to the long-term trends that exist out there at the moment, and the long-term themes that, as I mentioned earlier, things like digitalization that people are very much aware of, that are going on in their day-to-day lives, but probably consistently underestimate how positive they are for equity markets, given the largest stocks within equity markets are really what's driving these changes. So it can be anything from electric vehicles, semiconductors. Everyone's so aware now of the companies who are involved in the vaccines: Pfizer, Moderna, BioNTech. They're all listed companies. Just to give you another example of what exposures there are in the markets. I think it's never a straight line up. There's always threats. There's always issues for us to try and avoid and to manage our risks and manage our exposures. A couple into year end, quite high profile one currently is a mini energy crisis we are experiencing. As we try and transition to a zero carbon world, it's going to be hard to manage as the most assets which generate oil and gas are owned by the West, and they have very high ESG requirements now. It's difficult to invest for growth, whereas a lot of the demand is coming from the East, which is continuing to grow, and from emerging markets. So we've seen already high-profile spikes in things like gas prices in Europe. We think that is the extreme nature of the moment are quite short-term, and they will dissipate, but as the long-term trend, it is something that is going to be difficult to manage. Away from that, we have a situation in China. It's getting a lot of attention. And one of the largest property developers there, Evergrande, is in danger of defaulting on some of its bonds, and housing has been such a strong part of the Chinese economic story. So that'll be something that the authorities there will just have to manage. We don't believe, some people are calling it the China Lehman moment. We don't think that's it at all. But it is a situation that the authorities will have to just manage the unwind of that company. And it's going to take 3, 6, 9 months at least to do that.
So Phil, what would be the opportunities you'd see going into the year end?
Yeah, we think there's lots to get excited about as we look into 2020, into this year end and into 2022. In particularly, closer to home, we're seeing a really strong domestic recovery. Consumers in the US and Europe have a lot of excess savings, and we're beginning to see signs that they are very keen to spend that back on services, so on holidays, trips abroad, hotels, etc. We're also very excited about some of the large cap tech names in the US have pulled back quite a lot over the summer as people were worried about the Federal Reserve tapering and the impact interest rates would have on their valuations. We think this has been overdone, and as we go into earnings season now, the strength of the businesses that they own will really come to the fore for people. So we see a lot of opportunities there. And finally then, globally, industrials, we feel, offer some of the best solutions out there for the decarbonisation challenges that face us. And as we head into the COP26 event next month, we think there'll be a big focus again on the renewables sector.
Phil, thank you very much for that update. That was very informative. If you have any queries or questions on Phil's presentation, please contact your broker. They'd be delighted to answer any questions you may have. Thank you, and talk again soon.